In this example video, we'll be going over exercise 620, which is looking at how to put together the adjusting entries that are needed at the end of the period for a merchandising business to estimate the amount we're going to have to refund to our customers for returned merchandise and how much of that merchandise we're estimating that we're going to be having returned to us. So they give us some information. So they give us our sales in total for the period, as well as our cost of merchandise sold, and what we have currently sitting in the estimated returns inventory account, which is an asset account, it's a current asset account, and our customer refunds payable account, which is a current liability account. They tell us that we estimate that the cost of the merchandise that will be returned to us in the upcoming year is $400,000. So that's the cost, meaning what we had paid for that inventory. It also estimates that the percentage of refunds that we're going to have to give to our customer is 1.2% of the current year's sales. So we need two adjusting entries, one to record how much we need to put aside of estimating what we're going to have to give back to our customers in refunds, and also estimating how much of our inventory we're going to get back over the next year. So for the first one, estimating how much customer refunds we're going to have to give. When someone gives something back to us, it's reducing the amount of revenue that we're going to have. So we have to reduce our revenue by the estimated amount that we're anticipating that's going to be returned to us during the upcoming year. So we're going to debit our sales. In total, our sales was $51,600,000, and they said that we estimate that 1.2% of that is going to come back to us in returns in the upcoming year. So that means we'd have to reduce our revenue by a little over $619,000 to show that we're accounting for those returns that we're anticipating in the upcoming year. If we didn't do this adjustment, our revenues would be overstated for the end of this period, and they would not be fairly presented on our financial statements, because we know as a merchandising business that some of that inventory is going to be returned to us, and we need that reflected in our current year values. And what we have to do is we have to put a liability on our books. So that customer refunds payable, I'm going to owe my customers approximately $619,200 in refunds, refunding them the sales price when they come to return something to us. When they do return something to us, what they're going to return to us is our inventory. So what we have to do is we have to increase our estimated returns inventory account. And they told us we're estimating that we're going to get $400,000 back in inventory. And if someone returns something to us, that means it's no longer sold. So our cost of merchandise sold account needs to decrease by that same $400,000.